Hey everyone, welcome back to the channel. If you've ever wondered how the rich seem to play by a completely different set of financial rules, especially when it comes to taxes, you're not imagining things. The ultra-wealthy do pay taxes, just not the way most people think. In fact, they use legal methods, clever strategies built right into the system to keep more of their wealth and pay less to the government. But how exactly do they pull it off? And could you apply some of these tricks yourself? Stick around to the end, because we're revealing one technique that allows billionaires to pass on vast fortunes without triggering massive tax bills. You don't want to miss it. Let's break down 20 smart, legal tax strategies the rich use and show how some of them might just work for you, too. Number 1. They don't earn a traditional salary. Most people earn money from a paycheck, and that's taxed at the highest rates. But the rich, they earn from investments like stocks, real estate, or businesses. These sources are taxed as capital gains, which can be as low as 0% to 20%, instead of regular income tax rates which can go above 37%. Example: instead of earning $300,000 in salary, a wealthy investor might make $300,000 from long-term investments and pay significantly less in taxes. Number 2, they borrow money. Instead of selling assets, need money but don't want to pay taxes? Easy. Borrow against your assets. Wealthy individuals with millions in stocks or real estate can take low-interest loans using those assets as collateral. Example: a billionaire borrows $5 million against their stock portfolio. That loan isn't income, so no tax. Meanwhile, their investments keep growing. Number 3, they use real estate depreciation. Real estate investors get to deduct depreciation, an allowance for wear and tear, even if the property is increasing in value. This paper deduction reduces taxable income. Example: if you earn $60,000 a year from a rental property, you might deduct $30,000 in depreciation and only be taxed on the remaining $30,000. Number 4, they set up offshore entities tax-friendly countries. Like the Cayman Islands, Switzerland, or Ireland, attract wealthy individuals and companies because of their lower tax rates. While this sounds shady, it can be totally legal when done properly. Example: a global business licenses its intellectual property to a company in Ireland and pays lower taxes on that income. Number 5, they deduct business expenses. Rich people often run their personal lives through businesses. Business owners can deduct everything from internet bills to vehicles and travel if used for business purposes. Example: a business coach deducts a portion of their home as a home office, part of their car use for meetings, and even work-related travel expenses. Number 6, they donate for tax breaks. Charitable giving reduces taxable income. But smart wealthy donors give appreciated assets like stocks instead of cash. This way, they avoid capital gains tax and still get a full deduction. Example: donating $100,000 in stock that's grown from $40,000 allows them to avoid tax on $60,000 of gains and still get a $100,000 deduction. Number 7, they use trusts to avoid estate taxes. Rich families use irrevocable trusts to move assets out of their taxable estate. These trusts can hold real estate, stocks, or life insurance and legally protect the wealth from estate taxes. Example: parents place a $5 million property in a trust for their children. Upon their death, the kids receive the property without paying the usual 40% estate tax. Number 8, they create private foundations. Want to give to charity and keep control? Set up a foundation. Donations are tax-deductible, and the wealthy get to decide how their money is used, while often hiring family members to run the foundation. Example: a millionaire donates $1 million to a foundation he controls, gets a full tax deduction, and uses the foundation to fund causes he cares about over time. Number 9, They benefit from step-up in basis. When you inherit an asset, its cost basis resets to its current market value. That means you don't pay taxes on all the gains that occurred during the original owner's life. Example, your grandma bought a house for $100K that's now worth $1 million. If she gifts it to you before she dies, you owe taxes on $900K in gains. If you inherit it, the value resets to $1 million and you pay nothing. Number 10. They invest in municipal bonds. Municipal bonds, issued by local governments, are tax-free at the federal level and sometimes at the state level too. Example, a high net worth investor buys $1 million in municipal bonds paying 4% interest. That's $40,000 a year, tax-free. Number 11. They use 1031 exchanges. Selling an investment property usually triggers capital gains taxes unless you reinvest using a 1031 exchange. This allows tax deferral when swapping one property for another. Example, an investor sells a $500,000 rental and reinvests in a $700,000 property without paying any taxes at the time of sale. Number 12. They buy permanent life insurance, unlike term life insurance. Permanent life insurance grows in value over time. Rich people use these policies to grow wealth tax-deferred and borrow against them tax-free. Example, a $2 million life insurance policy grows a cash value of $500,000 over time. The owner borrows against it with no tax consequences. Number 13. They use S corporations to save on payroll taxes. An S corp allows owners to split income between a salary, which is taxed with Social Security, Medicare, and a distribution, which isn't. It's a legal tax split. Example, a consultant earning $150,000 might take $70,000 as salary and $80,000 as a distribution, saving thousands in payroll taxes. Number 14. They hire their own family. When you own a business, hiring your kids can create deductions. The salary reduces business income, and if the child is under 18, there's no payroll tax for them. Example, a business owner hires their teenage child for admin work at $12,000 per year. That's deductible, and the child pays little to no income. Tax. Number 15. They keep reinvesting instead of spending. If you don't sell your investments, you don't owe taxes. Many rich people avoid triggering taxes by continuously reinvesting their profits. Example, instead of cashing out stocks, they keep reinvesting dividends and unrealized gains to grow their wealth tax-deferred. Number 16. They harvest investment losses. By selling underperforming investments, rich people offset their capital gains. This is called tax loss harvesting and is often done at the end of the year. Example, a millionaire has $100,000 in gains but sells $30,000 in losses to reduce taxable gains to $70,000. Number 17. They move to low-tax states or countries. Moving can reduce your tax burden dramatically. States like Florida, Texas, and Nevada have no state income tax. Some even move abroad for tax purposes. Example, an entrepreneur relocates from California to Florida and saves over $50,000 a year in state income tax alone. Number 18. They influence tax policy. This isn't something you can personally apply, but it explains why so many tax breaks exist. Wealthy individuals and corporations spend heavily on lobbying to shape tax laws in their favor. Example, a billionaire funds campaigns and think tanks that support favorable tax treatment for business owners and investors. Number 19. They start businesses to unlock tax benefits. Businesses offer tax advantages not available to regular employees. That includes deducting startup costs, meals, vehicles, and home office expenses. Example, a person starts a content creation business and deducts their camera, laptop, and a portion of their rent. Number 20. They think in decades, not just tax. Seasoned wealthy people don't wait until April to figure out their taxes. They work with accountants and tax advisors all year to build long-term strategies that minimize taxes for life and beyond. Example, a family works with a financial advisor to plan for generational wealth transfer 30 years in advance, using trusts, insurance, and charitable planning, and there you have it, 20 smart, completely legal ways that the rich reduce or avoid taxes. Now, not all of these apply to the average person, but understanding how the wealthy think about taxes can help you start making smarter decisions today. Whether it's opening a business, investing in real estate, or simply contributing more to retirement accounts, the key is to think long-term and use the tools available to you. Now tell me, was there a strategy in this list that totally surprised you? Or maybe one you'd love to learn how to apply in your own life someday? Let me know in the comments. I'd love to hear your thoughts. And don't forget to like this video, subscribe for more personal finance tips, and share this with someone who's always wondering why the rich don't pay taxes. Thanks for watching.